I get told no every single day, probably 100 times a day, and to go again, and to go again, and to just go again until it works, and to force yourself into the room. So that's the only way to become successful.
So I want to introduce you guys to Mr. Benjamin Cohen. How are you doing, Ben? Ready to go?
I'm good. I appreciate you having me again. All good to go over here.
Absolutely. All right. So Benjamin is a partner and principal at HM Equity Management, acquisitions, capital market, debt and equity placements. About 6 years all in, a few years in private equity and 2 years as an entrepreneur, and over 40 million in assets acquired in current AUM, which is pretty impressive. 256 units as of now between two different assets, negotiating on 400 more. Personally raised over 12 million, 25 million all in, including the deals that maybe didn't make it to the finish line or fell through, which is still very impressive. And Benjamin, the question everyone wants to know, could you start us off with how old you are?
I just turned 27.
That's all we needed to hear. That's all we needed to hear, folks.
I get asked that a lot.
Yeah.
Shaving doesn't help.
I know. So I know we all wish we started entrepreneurship at 21. Benjamin here is going to rub it in our faces a little bit, and I'm happy to help him do it. I wanted you to briefly describe kind of your business model and what you're doing currently, and kind of share with the audience a little bit about what you're doing right now, Benjamin.
Yeah, so when I was 21, I worked for a guy named Chris Lerner. I was very grateful to get a shot working for a startup syndication private equity firm in Charlotte, learning and handling kind of acquisitions. So that's how I learned the business. So I learned the lingo, I built a financial model, and he let me loose, and I learned where deal flow comes from. I networked with a ton of brokers and bankers, investment bankers, different operators, capital market guys, and it was a great experience. And that was the beginning for me. We parted ways when I was 23. I had a few ventures that did not go well, tried different things here and there during 2023, 2024, waited for the right time to get back into the business, but always stayed in touch with my network that I built through 21 through 23 when I broke into the business when I was 20, between the age of 20 to 23 years old. So that's how I got into the business. Now, what it is that I do now, I handle, as I did when I first got into the business, I handle all of acquisitions, debt and equity placements. So by debt and equity placements, I raise most of the institutional equity. I source more JV partnerships. So minimum check size of 5 to 20 million. It's easier to raise that or find that because there's demand for that than it is for retail syndicated equity. I do have a handful, I'd say about 15 to 20 people that I go to that are, I guess you can call them ultra high net worth individuals that have invested in my first couple of deals. When it comes to debt, I built relationships direct to, so I don't have to go through brokers anymore. So I can save a little bit of cost at the end of the day with some larger firms in New York and Chicago. So I've been building these relationships for a while, a lot of pressing palms, shaking hands, traveling, lots of coffee here, lunch over there, dinner over there. So that's typically what I do right now. So lots of, I guess, business development and deal sourcing.
I understand. And what kind of motivated you to pursue this style career at such a young age? Because I know when I was fresh out of college, private equity was not the first thing on my mind. So what kind of motivated you and pushed you to start down this path?
Oh man, I guess like all of us, we all gravitated towards this knack and belief that financial freedom was possible for all of us. And the only way to that and to accelerate towards that is starting a business. And I've tried a few, I've failed a ton, learned a lot. I've lost a lot of money. I've made a good amount of money, but I went to college wanting to be a physical therapist. So it wasn't until going into my senior year of college that I read Rich Dad Poor Dad, the basic kind of financial literacy 101 book that ruined my life in the best way possible. That pushed me towards Grant Cardone, and then Grant Cardone pushed me towards kind of multifamily. And I knew that I wanted to get into the larger space, and I knew I was unemployable within the first year of working for someone else. So I don't know. It's a mixture of a personality trait that I have, a mixture of insecurity, pain, childhood, and a knack for financial freedom or a drive to achieve.
Absolutely. Yeah. I'm curious, like getting into that industry at that age, what were some roadblocks? Like, do you think you were, I wouldn't say looked down upon, but do you think people took you less seriously because of your age? Like, how did you navigate that?
Yeah, so the first few years were very difficult. The first few years going on my own were very difficult. I'd definitely say 2024 through 2020 going into last year was very difficult when I went on my own. Working for someone else gave me the stripes and the recognition I needed, since I was borrowing someone else's track record, someone else's infrastructure, someone else's platform, so I can at least get my name in the room. Since at the end of the day, all these people that work for these big fancy shops, they're commission junkies just like all of us that work for someone else. So I was able to at least learn the business and understand the moving parts and the players and how everything works. But going on my own, I look the same now as I did 5 years ago. So I've always struggled with people taking me seriously, but I've always been, I think the second you find a deal and you can focus on learning everything about the deal and becoming an absolute expert about your deal can help mitigate anything that my appearance could have. And now I just look young. It's not that I have warts all over my face or anything, but some people were turned on to it and others were turned off.
Absolutely. Yeah. I started real estate at 22. So I was similar, but I got to work for someone for a very long time. So not an issue I had to deal with nearly as much. I'm curious, how did you talked a little bit about it, but gaining the necessary skills and knowledge, did you have a mentor or a coach? I know you mentioned the Cardone, but did you have one person that you leaned on to really show you the ropes and make sure that you weren't making any grave mistakes?
No, so not in the beginning. I worked for Chris Salerno, so he wasn't really a mentor. He gave me a platform to go learn on my own. So the mentorship came from repetition. So that's where it came. That's where I learned. Now, when it comes to today, my mentor is definitely my partner. The deal that I'm raising for right now, called Archer at Willowbrook, would have been my fifth acquisition if I would have closed on two deals that I walked away from last year. I would definitely say after these full cycle deals two that I've closed on and one that I'm raising for and two that I did not close on, going full cycle on these five deal cycles have taught me more than anything that I could have ever studied in a book. And my business partner, who's 57, who's done this full cycle 30 times, and by full cycle I mean bought and sold, he's more my mentor. So it took me about 6 years to find someone to hold my hand through aches and pains, but I've made a lot of mistakes. There was a deal that I was under contract for last year called, I won't put the name out there, but it was a deal that I was under contract for last year in Humble, North Houston. It was 115 units. It was a $17 million deal. It was a loan assumption. And I had to walk away from the closing table because during diligence, I found out the income was not the bank deposits were not matching the income statement after my my earnest money deposit went hard. So I lost $75,000 of my savings. I was 26 years old, 25 years old. So I've learned a lot of painful mistakes. So there's no way around it. So it took me 6 years to find my mentor.
Yeah, it's a good thing to get drilled into early. I don't think there's anyone on this call that has not lost money. But as much as we want to have a perfect, clean record, stuff happens. Real estate is finicky like that. Things don't always go to plan. So you learn that lesson early, you get it out of the way, and okay, now I know what to expect. And so I'm curious, from your first capital raise that you did, what kind of challenges did you face and how did you try to overcome those on your first big raise?
My first raise was a $3 million raise. So it was too small to go to fund managers or family offices. So it was just brute force syndicated retail equity. And that was the hardest thing I ever done. And I never wanted to do that again. That was a lot of friends and family, lots of education, so every Mondays and Tuesdays, I have a call with 46 ladies that I teach real estate to. Calls like that, where it's lots of hand holding, lots of teaching what multifamily is about. And I love it. I absolutely adore these people, but it's very time consuming and it's lots of little checks. So from an admin perspective, it's very cumbersome. There's lots of tax season just today. I had 32 investors in that deal. So it was 32 K1s and 32 financial reports. So it was very difficult. I don't want to do it again. It was lots of phone calls. Lots
of underwriting. Sorry to cut you off, but pain. I hear the pain.
Correct. So lots of dinner parties and lots of traveling to go meet people and meet their families. And it's not something I want to do again. And it's more stressful. It's more stressful than working with a more sophisticated bunch because you're looking at the whites of these people's eyes and they're slightly less sophisticated when it comes to best private placements. And it's, these are hardworking people that saved money and worked their entire lives to entrust you with their cash. And they might not I usually don't accept anyone's cash that is not accredited, except my mother, who invests in anything. But
can't tell her no.
She gets mad if I tell her no. But I look at the whites of these people's eyes. It's very nervous. It makes me nervous. So I tend to avoid that.
Absolutely. Yeah. And we obviously play a lot in the retail side of things. So it's very educational. And like you said, it's awesome to teach people things they don't know. But at the same time, they have questions that institutional investors just don't have. and they have problems that institutional investors just don't have. And there's pros and cons to both, of course. But yeah, doing 50 financial reports every year and being what most investors expect is I gave you 50 grand, Benjamin. That means, and all of us on this call know, that means I can call you anytime, right? That means I can call you, I can text you, I can email you, and I can expect an update daily, right? And so you have to set that expectation, you have to move those boundaries, so it can be
and they do. They all have my personal cell, and they text me all the time, and I meet with one of them tomorrow for lunch, and I try to have that relationship with everyone. It's getting to a point where I can't sustain it anymore, especially as I'm buying more deals, and I'm under contract for one now, and I just got awarded another one. So as I'm growing my business, it's getting less and less sustainable, but it reminds me of the first deal. So I try to always honor my commitment to those people.
Absolutely. Hey, that's what makes someone a good sponsor operator is I'm available, because I would rather have an okay deal with a sponsor who is really transparent than a better deal, but I can't get a hold of them ever. So there's a give and a take to that. So I'm curious, obviously you're trending more towards going more institutional, bigger checks and all of that. What do you think is because I talk to a lot of people with Tim and for Tim and everyone, I want to raise money from family offices. I want to raise money from institutional investors because they have bigger checks and that's all they see. What do you think are some of the misconceptions or downsides of going away from retail, even though there is headaches that come along? What do you think are some things you hear, since you've been in private equity and more institutional check writers? What do you think are some of the pros and cons to each, would you say?
Yeah, so I received 4 term sheets in my career, 2 for a deal that I did not close, that I had to walk away from, and 2 for the deal that I'm raising for right now, that I will accept. 1, they've done all their diligence with me, so I know we will close. Knock on wood, who knows what happens, but the economics. So with the reason why most operators tend to gravitate towards building out their personal brand and building their business around the syndication model is because the economics are more advantageous for the sponsor. The promote's more GP heavy, which is fine. Incentives are aligned. You want the GP to make a lot of money, obviously, because then the LP will make money, because then the GP makes a lot of money. Everyone's happy. It's hard to find an institutional investor that allows for a heavy promote unless you've worked with them on a programmatic basis for a long time and you've done well for them and you've gone full cycle with them for a while. I'm working with 2 groups right now. I've received 2 term sheets and the economics are pretty cumbersome. A traditional split you would see in a syndicated deal is on a equity waterfall would be, let's say, an 8 pref, right? And then from an 8 to a 12, it would be split 70-30. And then after a 12, it's 50-50. That's maybe a market rate deal with a 2% acquisition fee, a 1% asset management fee, maybe a disposition fee or refinance fee, and or to keep it simple, you'd have maybe a 10 pref and then a 50-50. So those are, I guess you can call those market rate deals for syndicated retail investors. These promotes for these institutional kind of family office or quasi-institutional groups, they're non-existent. Now, they're not entirely non-existent, but they have all the leverage when it comes to negotiations. Yeah. As an example, the terms that I'm negotiating now, a lot of people are probably, they're going to hear this and they're going to think I'm crazy as a GP or an operator. I look at this more as a long-term approach because I want to get to scale versus more so of trying to juice as much as possible one deal. But because I'm okay, I live meagerly. I don't care too much about one deal. But a typical term sheet would look like operational cash flows would flow pari passu. So for those that don't know what pari passu is, it's essentially prorated depending on the GP's co-invest or the GP's dollars and the LP's dollars. So let's say that the LPs bring 70, the GPs bring 30, then the cash flows would be split 70-30. Upon a liquidity event or an exit or a refinance, that's where the equity waterfall will come through. The term sheet that I'm working on right now, it's about a 12% pref, which is on the higher end, and then it's pari passu. So there's no promo on one term sheet. The other is a 10% promo. So it's typically more punitive for the GP. They do put out more dollars. There is a promise for a programmatic relationship. These are groups that have discretionary funds. That is what I've been working on for the last 3 to 4 years. And I've been networking with these groups, and I've been to New York for the last year, maybe 3 or 4 times, meeting with these guys in their offices. And that's the plan. During this time here in Houston, I live in Houston. I moved to Houston to buy back during the lows of the all-time lows here. I am looking for a dry powder partner to buy back, even if it means I have to take a lesser promote for the first 2 years. I just turned 27. I don't mind making a little bit less.
Right. Yeah. And what I tell a lot of people is you can get bigger checks, but there's more terms and conditions. Right. There is more we'll invest if which is easy to say no thank you to a $50,000 check. It's not as easy to say no thank you to a $5 million check. And so the promote and what you can or can't get as a GP, it's a decision that I think some people see the number. They see the amount of zeros and like, that's what I want. But sometimes if you're doing a $2 million deal, retail might just be your best bet. Right? If you only need to raise 750 grand. So I'm glad that you broke that down to show people what some of the differences might be, because it's not all sunshine on either side. Right? You know what I mean? There's ups and downs to both.
It's your only bet. If you're buying a $3 million deal, you can only syndicate the deal. I think there's minimum check sizes, and they take that very seriously in the institutional space. They're all commission reps at the end of the day. They get the people that are putting the dollars out, they get paid a commission as a percentage of whatever they put out. So I agree with you. Yeah,
absolutely. And so I'm curious, what are some ways, especially with your age, both you can talk about retail or with the bigger groups, what are some ways you try to like establish credibility and build rapport with your investors?
There's very few people. I think the only person that knows me on this call is Scott, but since he knows me on this call, for those that do get to know me, I know my stuff. So I think for anyone that wants to build credibility with anyone is just to learn your stuff like the back of your hand. Whatever it is that you're raising for, learn your deal like the back of your hand, but don't sell it too hard. And if you have to sell it too hard, that means the deal's not good enough. The deal that I'm raising equity for right now, the money came to me so quickly. It's hard to believe. The deals that I raised for, that I had to walk away for, the money came to me very quickly. The deals that I'm pursuing, I know the money will come to me very quickly. I guess two things: know your stuff and don't oversell, because the deal will sell itself.
Yeah, it can be that simple sometimes. Know your stuff.
It really is.
Right. And one thing that I've stolen this from many people and recreated it. Everyone says it all the time. People don't invest in deals. They invest in people. Right. And so if you're a good person and they trust you, obviously the deal has to look good on paper. But my favorite saying is everyone's deal looks good on paper. That's why it's on paper. Right. And the deal will sell itself if you build a relationship and you show them you know what you're doing. Like they can go get a 10 pref or they can go anywhere for that. But they're coming to you for a reason. Right, because you know what you're doing. Even if you don't have, and this applies to people who are younger and people who are newer to the industry. We have people on this call every week. They're like, oh, I'm just starting out. Even if you don't have experience, you can make up for that in your knowledge, right? Because everyone starts somewhere.
You have to leverage partnerships as well. Sorry to interrupt you. My business partner, Ian, he's gone full cycle, as I mentioned, like 30 times, and he started his business. So I'm a partner at equity. Everyone wants to go on their own. So there's many hurdles that a lot of people have to go through to start their own business. And it sounds in this business, it's very difficult. The barriers to entry into private equity is so high. You have to have significant cash for deposits and pursuit cost. Then you have to have the liquidity, the net worth, and the management track record to even sign on the loan to get approval from the lender. Then you have to have the track record to raise all the equity from your investors. And then you have to win the deal and convince the seller and the broker that you're even credible to close and that you'll actually close. So there's a lot of things, a lot of hurdles that you have to hoop through. So there's a lot of things that you have to play to your strengths. So to my strength is, okay, I can source the equity, I can source the deals, but do I have the net worth at the age of 25 to sign on a $20 million loan? No, I don't. Will I hopefully in 5-10 years? Maybe, hopefully yes, but I can find a partner that does that. I can contribute enough value. And my value proposition to a partnership is high enough that someone will want to partner with me and I don't cost anything to them. So if you can find someone where you can fill that gap. Now, if you're on the other side of the equation, if I'm a wealthy dude, let's assume that I'm 40 and I'm super wealthy and I don't know anything about management. If you're 24 and you can run a property management business because you grew up in it for whatever reason, and you meet me, Benjamin, 40-year-old Benjamin, come to me and bring as much value as possible and work for free until you can earn a partnership or a seat at the table. And that's how you can get into this business at little to no cost and earn a seat at the table.
So that's the theme of our event next month. It's called Ultimate Partnering.
Yes.
This is not, I don't think, especially when it comes to raising money, you can learn how to go underwrite, go watch 1,000 hours of underwriting content. You'll probably know how to underwrite a deal, right? When it comes to money and people, that's something that's very hard to do on your own. It's like one of Tim's biggest no-nos. Don't try this on your own. Don't go into this business, just try to do it yourself. It's an ego thing. Usually you need partners because there's always someone that knows more than you. And why would you not leverage that? What's the upside to not doing it? There isn't really one, right? You're only running into more problems and liability if you do that. Very well said. Perfectly well said. That partnering is, I think, the quickest way to move up the ladder. And so I'm curious because we get asked all the time and we're like, hey, we raise from retail investors. We know some family offices and stuff, but that's not an easy door to open. So what are your methods for, I guess finding and attracting isn't really the right word, but how do you build a relationship with the more institutional level partners? Like, how do you even get in the door? Like, how do you start?
So it starts twofold. It starts with finding the deal. So for those that want to go bigger, focus on finding the right deal. Get in touch with Cushman, get in touch with CBRE, JLL, Berkadia, Newmark, Northmark, all the legacy publicly traded brokerage firms, and try to build enough rapport to get sent deals that are not the worst of the worst, to where you can get a quick look. These institutions up in New York and Chicago and Los Angeles and Miami, they have so much dry powder that they raised all this money for, and they have no deals to put to work. So if you can bring and show them deals that actually look financially viable, because the amount of deals that I also get sent that people ask me to help raise them for is, I get sent a lot of deals. It is crazy to me how many people tie up deals at bases and yields that are just extremely unattractive. So if you can focus on finding the deal, that's number one. Now, when it comes to your approach on how you find institutions and how they actually take your call, there's two ways you can do it. The cold email approach is extremely successful if you can attach a live deal. So it's a carrot before the horse. So it's for those that have pursued a live acquisition and you've been an investment final or you've been awarded a deal before, sellers typically ask, or brokers typically ask, like, where are you getting your equity from? And they want to talk to your equity, and it's hard to tell them with a straight face saying, oh, I have equity, because then equity wants to make sure that you have the deal locked up so they don't spend time and legal dollars before they work on your deal. So where was I going with this? The approach is, oh man, I was losing my train of thought. So there's twofold. So there's the cold approach with a live deal. Oh, the carrot before the horse. That's right. So you have to get the live deal first and then send it to them, which that'll get their attention faster. So you have to win the deal first, which is what I mentioned, why you need to get deals, or go through an equity broker. And there are a few equity brokers. There's one that I work with specifically. He lives in Westport, Connecticut, where all the hedge fund guys live. And he is phenomenal. I've been working with him for the last year and a half. And he puts me in touch with these groups. And my business partner, Ian, I obviously leverage his track record because that's what gets me in the room with them. He gets me in touch with them years before we even do a live deal. So the term sheets that I have now, the 4 that I've successfully had that has hit my inbox and they've signed, has taken me 18 months. If you just bring them a deal once and expect them to do it, they're not going to do it. They want to do lots of reps with you. They want to get to know you. They're going to do a background check. They're going to want to get to know your platform. They're going to fly down and visit you. I spent a month and a half in New York, all of February and March. They just flew down here 2 days ago. So it takes time. But if the cold email, finding the deal, going through an equity broker, I guess, to consolidate the answer.
Yeah. And that's something that I commonly have to remind people when they're wanting to go, because it sounds so good. I had this big deal. I can have one institution finance it. I don't have to call 50 investors. And that sounds good. But generally, I tell people, if you get in touch with them, they're not giving you money for at least a year because they did not get all this money by just investing on a whim. It's funny because with retail investors, it's very emotional. It is very educational. I'm asking questions and I want to know about the tax stuff and all this stuff. But with institutions, it is very numbers based and they want to see your track record. They want to see your numbers. They want to see your history and they want to date before they marry in that way. People are like, oh, I want to raise money for family offices. I'm like, you're not raising for them from this deal. I can tell you that. So it's a tough thing to get across. And so I'm glad to hear you echo that, hey, it might take a year or two. It's worth it in the long run, but it is very much not a overnight thing for 99%.
They want to say no to you. They want to say no to your. So your deal has to be so good, especially if you're a new relationship. They have their go-to sponsors. They work with RPN, work with Adveneer, they work with Nightvest, they work with American Landmark. Why are they going to choose equity, right?
They have options.
Right. They have options that they've worked with the last 20 years.
Absolutely.
They have to see that I'm serious enough and that I know my stuff enough. I have to break down every line item and I have to have a very detailed data-oriented response to every bullet point. And their email questions are like this long. And then they call me and ask me all this stuff on the spot. It's the type of it's my personality. I'm probably better with that than I am with kind of emotional. I'm more logical versus emotional when it comes to investing. So maybe I'm more geared towards that. But yeah, to your point, yes, it takes about a year and a half.
Absolutely. Yeah, it's a long game. right? The institutional players. So you have to strap in and be ready for that, or else you're going to be in for a rude awakening. Whenever you get ready to go for a raise, you said you have this handful of retail people you still use. Do you do any kind of like marketing when you're ready to promote a deal, or do you just send it to your few people on your email list and say, hey, I have this, come check out? Do you do a webinar? Like, how do you get it out once you have it?
So a lot of people do the webinars, they do, which I will do in the future as I will start investing more dollars into that. But no, it's more a few phone calls. I have 12 to 20 people that I'm close with enough that I'm part of a country club here that they want to see my stuff whenever I get it. And they take my calls. And then they're from here. So they drive to the property, we meet for lunch. And then Ian, my business partner, he's been in business since 2006. So he has 180 people that have gone full cycle with him 30 times. So he has his people that he calls. It's a cheaper way of doing it if you can build those relationships.
Yeah, absolutely. And for your limited retail list that you guys have, do you guys have an ideal investor profile? Hey, we want to raise money from doctors, lawyers, or is it just people we know? Deal.
So Ian started in 2006 in lifestyles. I don't know. I'm sure you're probably familiar with lifestyles. It's kind of like Total Wealth Academy. He met a lot of his now investors, his list of 180 plus people from there. They all started with $50,000 checks. I've been fortunate enough to be at a point where the people that I've met, they really have a need to invest just from a tax perspective. And they have to put out a certain amount of dollars just to write off a certain amount of dollars that they need by the end of the year. So they see me more as a solution, more as me chasing them. I guess they're more business owners more than anything. They're people that are ultra high net worth. They own a business that makes 30, 40, $50 million a year gross revenue, and they need to invest X before they get completely destroyed.
Yeah. And that was going to be my next question, right? What's their primary motivation for investing? And this is, I think, a good lesson for a lot of people. Something that Tim preaches in all of our programs, everything we do, our mastermind. You don't want people who want to invest. You want people who need to invest.
Correct. Yeah.
Taxes are the easiest one. Business owners are an easy one. Even more wealthy, the doctor, lawyer, engineer, the easy kind of avatar you can go after. Do they need to invest? Okay, cool. Now, a large portion of the education and the emotional part of it, you can take that out. Because you're like, hey, you have a problem, and I can solve your problem, whether it's a 1031 or capital gains. Taxes are an easy one because pretty much every real estate deal will have some tax write-off. And so finding that pain and saying, hey, I'm just going to go after people who have a tax liability, especially this time of year. It's a perfect time to do it. And all of a sudden you found your avatar, right? Because a lot of people say, who do I raise money from? Who needs to invest? There you go. It's the same thing with business owners. Not every business owner necessarily needs to invest in real estate. So you need to find the ones who do.
Yeah. And I do tend to spend as much more time. It's not to say that I really want to, since this is going to go out there, I don't want to preface saying $50,000 is less important than 500,000 or 500 million. But for the nature of our business, it's more scalable for me to spend more time with someone who puts in $1 million to 1.5 million into a deal than someone who puts in 50,000. So that's why I do my Monday and Tuesday calls with my investors who put in $50,000 checks, where it's a consolidated environment where I can do a Q&A kind of like this, and I can teach them everything. We go through the model. I send out monthly reports to my investors on a monthly basis, and we go through the monthly report. So everyone asks me questions, and I bring in my VP of operations and asset management. Sometimes she sits on, and they have a live kind of at no cost to anyone, and they ask questions. For individual people that are investing $250,000 or all the way up to 2 million, I'll handhold as much as possible, even after they invested, probably for the rest of my career, because those are people that entrusted me with a lot of cash, which is
absolutely
makes no sense.
Yeah, and then there's two ways to look at it, right? I think Tim tells this story. He had an investor who was very wealthy. Sometimes these guys, they're wealthy for a reason, right? He started with a $50,000 check, and if someone was to say, oh, that's too little, I don't want to deal with that, whatever, that's totally valid, right? You want to focus on the bigger check writers. Well, that guy, I think, wrote him over $1 million check not too long ago because he got his reps in and he said, okay, now I trust you fully. So now I'm ready to go all in. But it takes the skill to understand, is this someone that'll do that? Or is this a 50K every other year kind of investor? Is this worth all the hand holding, right? Correct. So it's not just how big is their check, right? But that's where the relationship comes in. Get to know them and ask, well, what do you do? And you go on vacation, all that stuff, right? So it sounds like you're really in tune with your investors and like what their needs are. And that's really how you scale at the end of the day. How well do you know your investors? Do you know what they want, what they need? Can you solve their problem? And then if you can, you're going to be a lot better off. I'm curious, like when it comes to cultivating long-term relationships with both retail or institutional investors, do you have any strategies you use? We've had people on that are like, oh, I do handwritten letters to my investors, or I send them a bottle of wine, happy birthday cards. Is there anything like that you do that's personal for them?
They all have my cell and we text a lot and we'll send jokes here and there. I have not done anything yet in terms of, I've sent over like a birthday card, I'll send over like a box of chocolates, or one of them they love sunflowers, for whatever, they love sunflowers. So I've sent over flowers once, but it's more the constant texting, the sending over the jokes, the memes, the videos, more so instead of feeling transactional, it feeling like a kind of as a professional kind of client relationship, more so as a friendship. And that's what has been the easiest thing for me to scale that. So it feels more personal. Because they end up becoming my friends. I moved to Houston not knowing anyone. These people end up becoming my friends.
Yeah. If you can build a real friendship with your investors, right? As we all know, the best way to grow your network is referrals. Because if I have a good experience with, you have someone say, oh, I went to this really good restaurant, right? It's the same way. Hey, I invest in this deal. I'm making a really good return. This guy's really cool. You become friends with them. They tell their friends. And then long term, their kids, right? And their nieces and their nephews. Like these are really 20-minute phone call can turn into a 20-minute or 20-year relationship. And I think that's how people should really view every investor call you get on. You never know what's going to happen, right? So making sure that you take the time to, oh, you like sunflowers? Cool. I'll write that down, right? Because it does matter because people want to feel seen, right? Like we're all spammed with ads and emails. It's constant now. So when someone takes the time out to be a real person, I think it goes a long way. So
going to see them is really important. I have a few investors that live in Sugarland, because Tim lives in Sugarland, I believe, but close to Tim. It's not too far out of I live in the Heights, so it's a 45-minute drive, but I go to them, or I have an investor that lives in Dallas, that lives near SMU, or when I go to New York and I meet with these institutional guys, I bring them a deal to their office. I'll fly to New York. I'll stay a couple of days from Monday to Wednesday, and I'll just call them and say, hey, I'm downstairs. You want to meet for coffee? I have a deal. That goes a long way. So it's because people don't really do that.
Absolutely. Yeah. It sounds like you're, again, really in tune with the relationship part of it, which is why you're at where you're at your age. So that's really good to hear. Whenever you are maybe sourcing a couple of deals, right? You're looking at multiple deals, you're doing your due diligence. How do you make sure that funds are readily available before, when it comes to, you have to send them this deal, right? So whether it's retail or institutional, how do you make sure, okay, I know I'm going to get LOI or whatever on this deal. I need to make sure I have the money for it, right? Which is like the biggest issue people run into. They find this home run deal. Well, I don't know if I have the money for it. So how do you make sure that doesn't come up too often?
It has. If there's a question that if there's any question that that you're not going to find the money, then the deal's not good enough. There's a deal. So the deal that I had to walk away from, I walked away from, I don't know if I've told anyone the story. Or if I did, maybe people don't remember, but I had a deal under contract that I had to terminate the contract in March of this year. It would have been my first acquisition of this year. Archer would have been the deal I'm raising for right now called Archer. It would have been my second. This deal, it was a completely off-market deal, direct to seller. Everybody talks about off-market's very rare in this business. It was a deal it was on foreclosure. It was foreclosed by a very credible sponsor that has 22,000 units. The lender was one of the largest lenders in the country. And some analyst didn't get approval. They just signed my unsolicited LOI without getting approval from their superiors. So my offer was insulting to them. It was here in Houston. For those that know Houston, this was Southeast Houston. The vintage was a 2003 vintage asset, and I had it under LOI under PSA for $88,000 a unit. So it was a steal of the basis. It was extremely distressed. So there was no going in cap rate because it was 50% occupied, but once we hit our pro forma numbers and everything is looking nice and dandy, it was a stabilized, untrended. So trended means rent growth. So no rent growth. So once we just hit 90% occupancy and we have normal expenses and everything stabilized, we're at a 9% going in yield or stabilized yield on cost because the basis was so low. I also bought my second deal right across the street, which was a 99 vintage deal, which was stabilized at 110 a door. So I knew the area really well. It was an absolute killer of a deal. I made 3 phone calls and I had people just foaming out of the mouth within 3 phone calls. So I knew within 5 minutes that this was going to be extremely easy. So what I've noticed is, especially in this market where unfortunately in 2019 to 2022, it was extremely easy to raise money,
Yeah.
which it was extremely easy to raise money because everything was just going up and to the right. I was looking at CoStar projections and I was looking at historical precedented data, and people were underwriting 7% rent growth in Houston. And then now it's 0 for the next 2 years. But since so many people took losses, and not just the average syndicator, Blackstone took losses. Blackstone was selling a portfolio across Texas with JLL, and it was a 10-pack between San Antonio, Austin, Dallas, and Houston. They had four deals in Houston that I was looking at. They couldn't get their number. They wrote off the deal, and they ended up recapping the deal internally because they had the cash and the liquidity to pay off the loan, so they can buy down the loan a little bit and just recap the deal. They're in a position where they have the cash to survive. So this didn't just happen to just the syndicator, but we're in a position where Houston 80s, 90s, early 2000s vintage product has sticker shock across the entire broader industry. So for Houston to work, there can't be a decoupling between location, yield, going in yield, and basis. So there's a lot of deals here. And by basis, I mean going in per unit. So because at the end of the day, all you have is basis. There's no downside protection if you end up. There's a deal that I'm looking at in League City. It's a 98 vintage deal. The cap rate is almost a 7 cap. It's a beautiful asset owned by an institutional operator, but they want 170 a door. So I'd have to sell it at 250 a door to get to a 16 IRR. It doesn't make any sense. Who's going to buy it 5 years from now, a 98 vintage deal when that's basically replacement cost? So there can't be a decoupling with that. And with that, I don't feel confident putting up my earnest money and looking at the broker and the seller thinking I can go execute on this. So if I find when I find a deal, there's a deal right now in Northwest Houston. It's 120 a door. It's a 2010 vintage deal in Jersey Village. It's a great pocket. It's supply constrained, good demographics. There's no delinquency. It's a home run deal, classic value add play. I know that will get funded. It's a 6 cap going in. That is easy. I know that'll get funded. So I think you need to know what people like. And once you can find that, then go for it. And then the money will come. You just need to know what people are looking for. And that just because I've had so many conversations with people and so many conversations with so many family offices, so many fund managers, even hedge funds. There's even hedge funds that put money into real estate. They're all looking for the same thing. They want high yield, they want a low basis, and they need a good location with good sub-market fundamentals. And if any of them sway away, they're just going to say no to Houston or Dallas. You have to be very disciplined with your acquisition strategy. These private equity firms, they're looking for a reason to not work with an operator because they see people like us as just fee-hungry prostitutes, pretty much.
Yeah, I'd say it's a pretty accurate representation of how they look at some of us. You hear all the time, like if you were an operator in 2017, 2018, you could have been a terrible operator. You still made a lot of money.
You made a lot of money.
It was not hard to raise money for many people. Like the last few years with what Tim does, we're having people like join our programs and do these things because they have to market themselves now. They have to educate people now. And 8 years ago, you just send an email. 8 pref, 70-30 split, 18% IRR, here's 50 grand. In some cases, like sometimes you didn't even have to have a phone call because real estate multifamily was like too big to fail almost, right? Rate hikes, bad operators, they all kind of coalesce. And now people are more worried than ever to invest specifically in multifamily. And so now you have to go even further. You have to do even more due diligence. And if you're not spot on with all the things you just went over, all it takes is one of them to be off and someone is out because there's 5 other deals in their inbox.
Exactly.
So if you're not very diligent, that you can run into that.
100%. One of the term sheets one of the groups, they're a group out of Chicago. They're all Jewish. They're great guys and they're phenomenal. And I thought they typically invest with Jewish operators, but I thought that was the case. But I think they just coincidentally just invested with a lot of Jewish operators. I'm half Jewish. My business partner is not. But the reason why I'm saying that is because typically they've invested with Jewish operators. But anyways, long story short is we were talking about my deal's an 80s deal and 80s deal in Houston that I have right now. My 80s deal in Houston, it's a hurdle that I already have to jump over with investors that are more sophisticated because 80s is old. It's 50s product. It costs a lot more to operate than a lot of people think. A lot more deferred maintenance, resurfacing costs. You have your turnover cost is a lot higher. The tenant quality is a little bit lower. Everything's just tougher. But the yield, my deal, it's extremely low basis. It's an extremely high cap rate. It's in a great location, anchored with a lot of good amenities. So everything is helping me. It's just the vintage. And he was the guy that flew down. It's the VP of investment. They don't have an investment committee. It's just one principal, the guy who calls the shots, and then this VP of investments that comes down, and he flew down, and we spent a few days together, and we had dinner, and we were talking about my deal, and he was telling me, he was like, we just got pitched a deal. It was a senior housing deal in Dallas. It was a 2021 vintage deal at 50 a door, and it was a 8 cap. And I'm like, I can't compete with that. If it's not good enough, they're just going to say no, because they have 10,000 people like me calling them, sending them amazing deals. So yes, it has to be really good.
Yeah, absolutely. And speaking of how things have changed quite a bit just in the last few years in multifamily and commercial real estate in general, what do you think some of your predictions are for the market, and how are you preparing to make sure that everyone's been saying, what was it? Survive 25, thrive in 26. That's what we've all been saying. So what do you think you see in the next couple of years, and how do you plan to navigate that?
I'm very fortunate because I'm getting into the business, and I'm building my portfolio at probably one of the best times probably in a generation, since probably 2007. I'm seeing discounts that I have never seen in my career. My business partner, Ian, has not seen discounts this low since 2008, 2009. So I guess the overall macro play is Houston and Dallas and San Antonio. You're going to have to ride out the concession wave, and you're going to have to ride out the absorption wave. There's still some units that have to be absorbed because of the overbuilding that we've dealt with Texas, because Texas is definitely very cyclical when it comes to overbuilding. They built a crap load of stuff not for whatever reason. Their money was cheap for 10 years. But once we ride that out, if you can invest in pockets, so I only focus on Houston. So I think of Houston as a square. So this is downtown Houston. If you can focus on the corners of the square, which are the more supply constrained pockets of Houston, those areas will do very well. So Houston, I think I don't remember if it was the US Census Bureau. I saw it a couple of days ago, but it was US Census Bureau or some very credible source. I don't know if it was CoStar or RealPage, one of the big ones, that said that Houston had the highest population growth. I think it was 129,000 people that moved to Houston last year, 2025. Dallas is right below at 120, and then everyone below was not even close. So the overall fundamentals from a supply demand perspective and absorption perspective will catch up. So if you can buy right, it's going to be a pure operations play. So it's more important than ever to invest with people and to partner with people that are focusing more than ever and being as diligent as possible to buy at the absolute lowest basis, because it's going to take 2 years to weather the concession storm. So the way I underwrite deals, I assume no rent growth for 2 years, so zero. And the only growth that I'm seeing and that I'm underwriting is the ramp down of the in-place economic vacancies, you can call it, the income deduction line items. So if you have delinquency, if you have any concessions, that ramp down, let's say you have 5% concessions, that's going to be ramped down to 2% over the next 36 months. That's the only growth that needs to be underwritten. And that is what I'm seeing today. And then obviously the random crap that no one can underwrite for, like ICE raids that happen all over Texas, and you have a war in Iran. If you can buy cheap enough and wait for the sellers to come to you, which is what's happening here, especially in Houston and Dallas and San Antonio, then you're going to be positioned to ride the bottom of the wave in ways that I'm 27, so I'd be participating in the perfect time.
Absolutely. Yeah, I think that it's a very interesting time, especially in Texas. I'm in Florida, so it's not too dissimilar here. Overbuilding is insane here in Tampa. Yeah. I couldn't tell you how many apartment complexes I've seen gone up in the last 5 years alone. And so it's a funny place we're in, because you see so many people on the sidelines, which only means there's more for everyone else. You see it time and time again through history. Whenever everyone else is scared of something, that means there's opportunity for somebody else.
I agree with you, but there's a lot of people that are still buying. There was a deal that just closed. It was an 84 vintage deal. I'm not going to name the name of the operator, but it was an 84 vintage deal about 3 miles south of where I'm buying my deal. And they paid $110 a door for my deal. And it was a 4.5 cap for that deal. And, they're underwriting 3% rent growth starting in year 2. They're underwriting year 1 pro forma expenses coming down by $500,000 immediately, assuming that their taxes are going to come in, their insurance are going to come in by a lot. They're going to cut utilities. And then I'm trying to think of something. They were assuming a 5.5 cap at exit for 80s product, which is extremely aggressive. I underwrote a 7 for mine. So there's a lot of people that are still buying wrong because they need the cash. Or the company that I'm buying my deal from right now, they bought 24 deals in 2021 because it was very easy to buy. So they scaled their infrastructure their payroll, their overhead so much that now they have responsibilities and families they have to feed, that I get it, but they're also buying wrong. For those that are raising capital for other people's deals, just make sure that you're buying right, because this is the right time to do it, to get back in. But there are a lot of people that are forcing it, and they're not being patient enough, because you can lose your shirt if you're not patient enough during this next 2 years.
Yeah, I think that was very well said, because just because there's more opportunity doesn't mean that it's any less risky. This is still real estate. And so if you don't do your homework, deal might look good. If you don't know all of the factors, you can get burned. And we see it all the time. Really well said. This is a question I ask everybody. It's a little different, not just because of your age, but how long you've been in the industry. But if you could go back and restart, do you think you would do anything differently? And if so, what would you do differently?
I would say no as of now, not because I did everything correctly. I made so many mistakes so far. I've had a few wins. I've had a few wins that are performing well. The 2 deals that I own right now, God willing, they're still providing 8% distributions to my investors. Everyone's nice and happy. I made a little bit of cash. God willing, everything goes well. But I think I timed it well. 2023, 2024, I was flipping houses, and I was flipping houses until I could buy my first multifamily deal. So I think that timing there was okay. So I'd say no. I'd say no to answer your question.
Maybe buy some GameStop or something like that. But I tell people and ask that question, I'm like, you can't say buy Bitcoin. That's off the table. For me and you, we were a little too young to get on the Bitcoin train, but I think that's a good answer.
I would have majored in business. When I was 20, after I read Rich Dad Poor Dad, I started my first Airbnb business. I found a few investors to give me a line of credit, and I furnished 5 rental properties in Charlotte where I was going to school, and I just became a glorified Airbnb hotel operator, and I hated it. But
that's the toilets, man. It's where we all start.
But I did, and I hated it. So I would have gone to business, gone to school for business.
Yeah. I can resonate with that very well. What kind of advice do you think you'd give someone, which I think is actually extremely rich coming from you? Because people all the time, where like authors and movie stars, they don't get started until they're 30 or 40 or whatever. And some people that's our age or older, see you like, oh man, he's so successful, I'm behind. But that's not always the case. So what advice would you give to someone who aspires to raise $10 million, go acquire hundreds of units, but doubts their ability to do it? What kind of advice would you give?
I feel like I'm sure everyone knows Rob Beersley. Rob Beersley's 3-4 years older than me, and he owns $1 billion in real estate. He got in the perfect time, right? Like he bought his first deal in 2017, and he came from a little bit of cash and he raised some money, and then he built his track record, and then in the go-go days in 2020, 2021. So, and I think he's 30 now. So he's a couple years older than me. So I guess if you always look at someone that's a little bit ahead of you, it's very easy to fall into that trap. I wish I would have started sooner as well, but I'm not a great public speaker. I'm actually not great at doing this. I tend to talk very fast. I tend to stutter on my words. That's probably why I'm able to raise money. People think I'm imperfect and I'm human and I'm not very polished, but I'd say I have no secrets. Everything that I could say is public. It's out there on YouTube. It's the guru kind of motivation crap that you can see on YouTube. It's 100% true. I get told no every single day, probably 100 times a day, and to go again. And to go again, and to just go again until it works, and to force yourself into the room. So that's the only way to become successful. And regardless of what hurdles, people want to help. I know there's a lot of stuff out there saying, oh, people want to doubt me or people are against. It's not true. If you're a good person, you work hard, you put your head down. I'm not a flashy person. I don't really post anything online. I'm very quiet. I think people want to work with me. I try to do good by people. I'm extremely transparent, probably to my own demise with my investors. So putting yourself out there, getting told no, and going again relentlessly is the only advice I can go. And it doesn't really matter what age you are. The only point is to start. And that stuff, you can find that for free on YouTube. And it is 100%.
I love that answer, because successful people want other people to be successful, and they got to where they're at because someone helped them too.
Right.
The I'm always doubted mindset, it looks good on YouTube, but in reality, it's a very negative way to go about trying to level up. Because like we said earlier, everyone needs help, everyone needs assistance. So being able to get over the no's, and if you want to raise money, man, you better get used to it. This is the capital party. It's capital we're talking about. You're going to be told no more than anything else in your life if you're a capital raiser. And you better come to terms with that.
Yes, right?
Yeah, you better come to terms with that, or else you're going to be feeling very stuck very quickly.
Never celebrate a win until it actually closes. Like, You think you're going to win. You think you're winning because you have a deal under contract, and then boom, something falls out of contract, or boom, your anchor investor falls out, or boom, your insurance premiums come in, or boom, Fannie requires another indemnity or another escrow of $250,000 that kills your equity raise, or whatever. Your debt proceeds get cut by half because the capital markets blew up because there's a war. There's so much that's out of your control in this business. It's absolutely insane. So you just have to have that's one advice that I can say. If you want to be a GP, if you want to be this is one of the only advice I give. If you really want to be a GP, you have to have the stomach to do this, because if you're putting up your dollars on the line, which is what I do, it is an emotional roller coaster like nothing I've ever seen. And then when someone invests in your deal alongside you, because I invest in all my deals alongside my investors, you're a steward of their capital. So that's even more stomach you have to make sure that hopefully you're doing the best you can to protect their capital and preserve their money and grow it for the next, hopefully 20, 30 years. If you're going to get into this business, have a stomach for it. If you don't have a stomach for it and you can't stomach the volatility, do not get into this business, because you will have severe IBS. You will go bald in 2 years, and you'll have hernias everywhere.
Yeah. George Abreu with Elevate. I'm not sure if you know about them. At our event last year, he went on stage and someone asked him, I think, a question similar to this. And he said, do you have children? And they were like, yeah. He's like, okay. If you want to be a GP, it's like having a child that just loses money all of the time and every conceivable. It's really, until you have a kid, I guess you really don't understand it. It's like, it is truly a child that you have to spend. You think you want to work 40 hours and be a GP. Good luck. You're working 100 hours minimum just to make sure the wheels don't fall off. So if you've raised a child, you might have a good idea of what it's like to be a GP. And the room loved that. So I think that's really good advice. This is why we do the fun to fun stuff, man.
It's the best model. It is the best. It is the best.
Come to the dark side and just raise money. You know what I mean? I really love that answer. It's a really good answer. But you've been super generous sharing your knowledge with us today. How do you think the audience can support or get back to you, and what's the best way for them to connect with you?
Oh man, I don't ask for anyone to invest or to help me raise for any deal that I have ever. I will not ask for you guys to do that ever. I'm more than happy to educate you guys on my deals and show you guys what I'm working on for the next year, 2 years. And if you guys do decide to ever work with me in the future, come down to Houston and we'll do a lunch. The only thing you guys could do to help me is potentially work with me in the future once you guys feel comfortable that you know that I'm real. So that's the only thing you guys could do for me.
Perfect. And what's the best way for people to get in touch with you and connect with you?
I believe Hillary just reached out to me on LinkedIn. I see her on my phone. You can reach out to me on LinkedIn. My name is Benjamin Cohen. You guys can also, I'll put my name in the chat. Not my name, sorry, my email. You guys can reach out to me on email, Benjamin Equity.
I put your LinkedIn down there in the chat.
Perfect. BenjaminEquity.com.
All right. So if anyone wants to reach out to Benjamin, connect with him,